What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. All right, that might be the only time that I play it that way. I think it's a little bit much to subject guests through it. Normally, I just edit that in, and I think I'm going to continue doing that. But that was an experience. But anyway, what's going on here? I got some great news for everybody here. Robby Butler is who I'm joined with today. How you doing today, Robby?
I'm great, and you should leave that in. It gets the guest enlivened. It's a good wake-up call to say, you've got to be ready to perform now.
That's the ticket. That's the ticket. Well, I got some great news and it'll definitely energize you, which is, I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, investors, buyers, sellers, all that kind of fun stuff. And you might ask yourself, why would you do that? And the answer is, if you've ever heard of one of those private deals, those off-market deals that you're not allowed to publicly discuss, well, you should also know that SEC, securities attorneys insist that you have documentation of your prior association of relationship, or else the SEC will get ants in its pants and they'll take away your business, which is bad. So I have my documentation all baked into this little format here, and the benefit for you, there's a couple of them. One is you'll be able to more effectively communicate on the subject of commercial real estate. And then the other benefit is you'll know how my guest fits into these deals. But before we get too excited about real estate, Robby, do you want to say a thing or two about yourself?
Sure. I've been investing in real estate since my early 20s. I am now a member of the Y Street Capital team as our director of capital markets. And that's a fancy phrase for saying I work very closely with our investors and our capital sources to find out what's the right fit for them and how we can best serve them as an investor. So I spend a lot of time listening and as little time as possible talking, but every once in a while I get to listen to the dubstep and I go, great, now is my chance to talk.
I love it. I love it. So now it's time to bring up the little slideshow here. Here we can go on the side. I think this one's a little bit better, but I got to say, but wait, check your eight. So Robby, you're youthful, so I don't know what your level of technical proficiency is, but perhaps you can see through the camera and down under the frame, and there might be this hideous subscribe button that the people maybe should do something about. It's ugly and people will judge you. Okay, it's just a stupid joke, but that's, I've been using it for too long. I keep on doing it, but it's my segue into the 5 distinct motivations. Now, personally, I've now interviewed literally hundreds of different people in the commercial real estate space, and then I've met a whole whack more, and everybody has their own unique reason why they are attracted to commercial real estate. But I found that they fit pretty neatly into these 5 different categories. And the reason why it's relevant to people in commercial real estate to know these motivations is because these deals take months to close. They take years to go full cycle. So you really need to know what's going to keep this person from throwing in the towel. And that's why we go through these. Now, the first one is preservation of purchasing power. What on earth is that? Well, some people out there, they don't have to have a full-time job, and the way that they make ends meet is from the proceeds of ownership of their portfolio. In other words, the profits that come from ownership, that's how they pay their bills. And you might start to wonder, as you start to consider people in that situation, you might say, well, why would somebody like that want to make another acquisition given the different challenges involved. And there are two main reasons that tend to pop up the most frequently in my experience. One of them is when inflation rears its ugly head. Well, that's going to eat away from the purchasing power of your cash flow. So that's going to make it a good reason to make the next acquisition. But the other one is buying at the steepest discount possible because of distress or an asset crash. Now, of course, everybody should do that. But some people, they have more of a transactional business model, so they need to be making different acquisitions all the time. Whereas a lot of people, if preservation of purchasing power is a priority, then that high volume is not going to be the best thing. And full disclosure, for me personally, I'm not to this phase yet in my career. More accurately, I'm trading time for wealth. Specifically, it stems from my tech background in digital security and online credit card transactions. And I ended up owning my own agency for CRM online funnels, and then all roads eventually lead to real estate. And as I was working for a guy who was flipping 10 houses a month, they were doing 10 house transactions per month, well before, for years before they ended up hiring me. And it got me to realize that as you pursue higher salary, higher wage, well, you're losing a whole lot just to taxes. And it makes more sense to do the activities that the tax code provides assistance to you. And so that's what I mean when I say I'm trading time for wealth. So that's really what I'm up to. But I get that for a lot of youngsters, that's a little bit too abstract. Usually when you're talking to younger people, they want to hustle like crazy right now, and then they want to be able to take it easy in the future. And maybe that's not the 100% of the crowd that this best describes, because there's also a huge portion who've spent long careers being told what to do, and they just want to be able to free up their schedule, make up their own decisions, and that's a great motivation. And so nothing against that. The only thing to be careful about is very frequently people think that this is everybody's motivation when it comes to real estate and whatnot. And I assure you that's simply not the case. It's not filled with people who just want to retire. Some people are just plain ambitious. They're after that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that is why they're going to hustle into their 90s. And sure, in some circles, that's absolutely vilified. And I don't think that's entirely fair, because you need to have somebody who's not asleep at the wheel, somebody who will hustle into their 90s, or else these different properties will fall into disrepair. So that's why this motivation is fantastic to have on your GP team as well. But the last group, they're also going to hustle into their 90s, but their motivation stems from the fact that they picked a sector of society, or maybe it's animals, maybe it's the environment, who knows, but they figured out that there's a large financial component to making a big impact, and that is why they're making their acquisitions. So, Robby, of those 5 different motivations, what combination of them would you say describes you best?
So I've got a background that says to me, you have to think so holistically that you're considerate of each of them, because things may change for you. And so I know I am motivated first by the cash flow component, ensuring that the income coming into me is not for a retirement target, but for the wealth accumulation piece. So for me personally, it is about that wealth accumulation piece. And yet, equally along with that, I value the capital preservation a lot as well. It's less. I think my fiance values the capital preservation more than the cash flow component, but that's why we're a good pair.
I love it. I love it. And I'm glad that you were bringing it into, reality a little bit, keeping it real, because often when you come from talking about motivations, it's easy to seem naive or overly optimistic, something like that. And I usually put a pin in it by this next bit here, which is talking about the tolerance for risk. Now, the real reason for this question is because if you've ever been involved in one of these off-market deals, these private syndications called 506B deals, then the securities attorney in the mix, and there really should have been one, or else that's a huge red flag. They should have insisted that all the people who are partners, they fill out this suitability questionnaire is what a lot of people call it. It's an invasive financial questionnaire. It asks all kinds of intimate questions like what's your net worth and that sort of thing. But when I was going through this questionnaire, when I got to the tolerance for risk assessment question, I felt it lacked utility. I felt like I couldn't really use any of the replies that were there. So I made my own one, and it's a fill in the blanks question. And it is. There are many popular investment asset classes, but I think blank is too risky. So, Robby, it can be inside real estate, it can be outside of real estate. What's too risky for you to invest in?
Too risky? I would say whiskey barrels.
Whiskey barrels. I like it. I like it.
Not only
All
do I
right. So,
not,
so what?
not only
Yeah,
do
please
I not,
expand. Yeah.
I don't drink alcohol, so too risky from the sense that if the market suddenly collapses and I'm left with a barn full of whiskey barrels aging, I can't use them. But also, I don't find that the futures markets and the financialization of that asset class is going to do anything good for the alcohol industry. And I have friends who do it, but it's too risky for me.
Yeah, it's too risky that they come over and drink all your whiskey. So that's okay. All right, but anyway, the next slide here, it's the favorite deal metrics, and I gotta tell you, for the first few hundred chance encounters, I didn't include this slide, even though I really, really wanted to. But I felt like it was a little bit unfair to one particular group of people in this industry who are the marketers, the PR, the front of house, the attractive front person of the organization. But it hit me that even if that's your role in these commercial deals, then you're still going to focus in on a few different metrics, even though you're not going to be up to your eyeballs in the different assumptions that an underwriter would have to do. And for anybody in the audience who's only listening and not watching, I read out the 14 suggested ones that I have on this list. It's not an exhaustive list, so you're welcome to add one that's not on here, but here they are. Cash on cash, IRR, which is internal rate of return. There's cost per door. There's the net operating income, or NOI. There's the going in cap rate, which is really saying how much of a discount are you getting compared to buildings in that area. Then there's the loan interest rate, which is particularly important if you have any seller carry, if you're assuming a loan or something like that. Then there's the occupancy rate. Be careful that you know that the vacancy rate is just the inverse of occupancy, so it's the same thing. But the average income where the property is located, amortization period of the loan, the difference between the market versus the in-place rents, the population growth where the property is located, so you have some sort of idea of the baked-in appreciation from just demand. Then there's the sponsor record, which is how many deals have gone full cycle, how many are on the go right now. Then there's the waterfall split or exit strategy, which is what's going to happen to your investment after your capital and principal has been returned. And then we have DSCR, which is debt service coverage ratio, which is how much of the loan goes out the window immediately just in the form of the loan costs. So, Robby, again, you're welcome to use one that's not on there, but do you want to give like a top three on that list?
Oh, top three. I'd only come up with top two. So definitely the one that I prefer the most, the one that I rely on, though it only really allots for the first year of ownership, is cash on cash return. I mentioned that cash flow is most important to me. And so if I can see a high cash on cash return, perhaps because in my local market, I'm buying a foreclosure, or in what we do at Y Street, if we can see perhaps an immediate value play that makes the cash on cash return spike, fantastic. I lean on that metric. Personally, I also lean on cost per door because I'm coming out of St. Louis, Missouri, where our cost per door is minuscule compared to some markets. And so some people laugh when I say my first apartment acquisitions personally were at $45,000 a door. And someone think, oh, like a pile of sticks with a door on the front. Like, no, this was a real apartment and it looked kind of nice, but it's how it was in our market. So those two are specific for me. But I guess I also do spend a lot of time thinking about net operating income. That's, again, I grew up in the apartment world, so that's where my basis is for all commercial real estate. So net operating income is hard to avoid, and if you can get keen on what drives the NOI, you generally can solve a lot of other problems with that metric.
I love that. I love that. I'm just eating up that answer like a delicious subscribe sandwich. It's very subtle, I know, but it's my way to remember that it's time to bring out the Dan Does Deals Commercial Core Competency Cube, which has the 6 different roles in a commercial real estate deal. It's a little bit leaning towards multifamily specifically, but the reason I'm going through it is because it really is the linchpin in your ability to effectively communicate the subject of commercial real estate deals, because you need to know the independent roles that are involved. And as I'm going through these 6 different roles, if you're thinking, wow, I really need to get me one of those, well, the good news is it's absolutely free. You can go to dandoesdeals.com. There's a big prominent looking button where you just click on it. It goes straight to the PDF that you can print out, and you can fold it and show it to your friends and family and all that kind of stuff, and get in practice. And yes, you heard me right. I committed the cardinal sin of marketing, which is you should never ever give your freebie away without asking for some sort of contact information, like an email address. And if that isn't worth hitting the subscribe button, I don't know what is. But let's talk about the 6 different roles. First of all, there's the repositioner. The repositioner is the most visible person in a commercial real estate deal. They're constantly engaging the public, but what they're really doing is they're curating of deals. They're doing all sorts of paperwork. They're looking at all sorts of different properties, and they need to do the math. They need to underwrite the deal and figure out, first of all, is this property even making the amount of money that the seller slash broker claims that it is? Because okay, but the most peculiar part of being a repositioner, as far as I'm concerned, is the fact that they have to have a vast network of financiers. And financiers, they're not on the GP teams of a commercial real estate deal. They only deal with the owners of the property and the paperwork and the cash itself. And the reason why repositioners have to have this vast network of financiers is because if you can secure a more advantageous loan, aka cheaper money, that's going to go straight to the profitability of the building. And so that is why the repositioners are constantly engaging with potential financiers. But of course, the more traditional spot to find that upside, which is really the responsibility of the repositioner in the first place, they're going to look at operations and stop those Benjamins from going down the toilet. But of course, there's more to operations, even in multifamily or even self-storage, than just unclogging toilets and collecting rents and mowing lawns and all that kind of fun stuff. If you know me well, then you know my deep secret, which is I'm from the internet. So the question is, well, how can a guy like Dan wind up on a GP team far away? And the answer is I help out not only with the web-based assets and automation that go along with the business, which of course, even if you are focusing on 100 units or more, you're probably outsourcing to a third party. So the real role that I tend to show up in on a GP team is if there's a vacancy issue. You need somebody with some serious marketing chops to step in and address the issue of vacancy, because it is the deal killer. So that's what I'm up to as an operations contribution. But there's only going to get so much upside from optimizing the expenses and operations and all that kind of stuff. So the next place the repositioner is going to look is they're going to get a contractor team involved. They're going to upgrade the property, because then the next residents should be happy to pay more than the previous ones just on that basis alone. But as if only things were that simple. You can go ahead and gold plate the toilets, but that's not going to represent a return on investment. So you need to be really, really careful with the contractor team and making sure they're keeping to schedule and all that kind of stuff. And if you're from the internet, like me, then you need locals. You need boots on the ground, somebody who can be there in an hour or two, because there's no way that's going to be me. I'd still be stuck at an airport in an hour or two. So somebody else has to take that for the team. But let's do a hypothetical to address the last item on the cube. Let's say you are an engineer, or maybe you operate apartments already, or maybe you're a physician or an attorney or something like that. Maybe you own a few rentals and you're thinking to yourself, hey, I know how to buy a house. I put down my down payment, I borrow the rest, and I pick the place up. So you get this idea in your head. Hey, I bet you if I hit up the people in my circle, we put in like 100K each, I bet you we could pick up that 350 unit apartment complex down the road. So full of confidence, you turn around to the financiers at the bank and you say, I want to buy that building for tens of millions of dollars. You don't happen to have, I don't know, say tens of millions of dollars you want to lend us, do you? Well, they're going to have some questions on their mind, even more than is obvious. But if you're in a mentorship program or if you have a guru, I encourage you to listen very carefully to this next part. The financiers are going to ask you, who's your sponsor? Who's your KP? What's that all about? See, at the end of the day, financiers are taking depositor money, for lack of a better term. It'll be depositor or investor money, and they're lending it out to try and get a profit. And they're not going to lend it to a group of people unless somebody in the fold already owns a similar asset, because otherwise they can be confident they're going to take all that money and just run the place into the ground. So that's why somebody on your team has to already own a similar asset, and then you need a certain amount of liquidity between the team, and then for collateral among the team you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Robby, it says straight out on your title there that you're director of capital markets at Y Street Capital, but what pieces of the puzzle do you tend to focus on?
I focus on the sponsor piece as much as humanly possible. That is the thing that I'm the most enlivened by, and part of my backstory would tell you why. But in the past, I have also been the contractor, and I have even done a little of the repositioner, which I look back on as a very sweet way to learn the industry. But man, oh man, am I sure glad to be doing what I'm doing now with Y Street.
I love it. I love it. I love it. So let's talk about buy box then. And when real estate people are talking to each other saying, hey, what you looking for? What's your ideal property? What's your buy box? We're really asked about three main things. The first one's geography. Where is it? Which state? Which county? Also, like which neighborhood is also going to count, and so you need to get that out there first of all. But the second one's going to be size, and most of my guests on this show, they are in multifamily. The way you define size in multifamily is by the number of apartment units, and the reason why it's relevant is because the type of team that focuses on 10 and 15 unit apartment complexes are going to be fundamentally different from the ones that are taking over 150 units or more. And of course, that's especially going to be important if one of you is from the internet. So that's the size. And in other forms of real estate, it might go by square footage or acreage or whatever, but that point about size, it still remains. But the third one is usually called class. I prefer the term desirability because it's actually more than one thing, and class is a singular noun. But anyway, the two different parts of class are the condition and the area. And if you're talking about condition, that's how beat up is it? Like, is it a recent build or is it already old? And has it been well maintained or recently restored and renovated? And then as far as luxuries and amenities go, it's how nice of a place is it? That's the condition. But if you're talking about area, if you're talking about residential in particular, then the school districts are going to matter. But the universals of real estate are the crime rate is going to be important. And then the other old broker trope of location, location, location. If I translate that into something that I think makes sense, it means traffic, traffic, traffic. If a gazillion people pass by a place every single day, it's automatically going to become more valuable. So that is what they're talking about with the area. But both the area and the condition are ranked the same way as in grade school, where you've got A plus at the top, and then A minus, and then B plus, and so on. So Robby, as far as you and your group goes, what's your buy box?
Gosh, so in simple description, we have three divisions of the company: multifamily, self-storage, land development. Multifamily, we won't do a deal under 25 million. We're geographically agnostic. I'm kind of market agnostic. We will go anywhere we feel the supply demand drivers are different. And we would really prefer to be, let's call it B minus and above. We're a development firm by trade, and so we won't do things that are too outside of that buy box, but we will consider a heavy value add. That's kind of the baseline. Self-storage, we want to do 60,000 square feet and above. We want to have the opportunity to do some additional development of the site, perhaps add some additional storage facilities onto an existing site. That's good for us. And then land development, if it's greenfield, it has to be 20 acres and above. If it's infill, it has to be at least 2 acres. And typically we'll want to put a multifamily project or a self-storage project there. But we are open-minded, I think, almost to a fault. We'll look at things and we'll think about what we might do with them. And so those three divisions, that's where we try and keep to.
I love it. I love it. So let's talk about people. And one of the best things of switching from digital security over to real estate is that people are so much more welcoming in commercial real estate. It's really something to behold. Like at first, I was actually so suspicious. I was like, "What's up with these people? There's got to be that they're being like super duper fake." But that's not what's going on, which is really amazing. I chalk it up to the fact that these deals are so multifaceted and everybody has to specialize on their own swim lane. And it means that people are really eager to build more teams, make more deals work, and then that way they're connected with the owners of more properties. But at the same time, we all have our own unique skill sets. We all have our own proclivities or abilities that we can help some people with more than others. Me personally, because I'm from the internet, the sponsors and KPs have been traditionally the majority of who I try to attract because that's who I can make the biggest difference for. But at the end of the day, a lot of us are a little bit coy about the fact that we're in the business of deploying capital and therefore are attracting financiers pretty much all day, every day. So that being the case, Robby, if you have any 506B deals, don't go mentioning them in the same breath as as asking for investors. But who's out there in the audience that you can help the most?
I can help investors who want to have high growth assets to add to their portfolio. Should never be your only isolation, just like any syndicated opportunity should never be your only asset, just like real estate should never be your only asset. But for those who want to have the sweetness of development on top of their portfolio, the high growth component, that's who we help.
All right. I love it. I love it. And so then the question on everybody's mind must be how to reach out. And I'm going to sandbag that conversation for a second and talk about myself. I'm fortunate enough to have this super distinct last name, which makes me really easy to find on social media, especially LinkedIn, which is where I spend most of my social media time. You can also check me out. I have a few different books on various different business skill building topics. You can check that out on Amazon.com. But if you are looking to raise capital for your business, regardless of if it's just a regular startup or if it's a real estate thing, just know that there are regulations about that. And I encourage you to pause the video. You can scan this QR code that's on my screen right here, and that'll take you to the FAQs page of 506BME, which is the platform where I offer the service of maintaining the backups of your documentation of your substantive relations with your investors. The reason being, even if your laptop falls into the bathtub, the SEC is still going to need to see that documentation of your substantive relationships, or they could assume that it was a public solicitation and they can take away your business. And pardon my French, but that sucks. Anyway, Robby, if people want to reach out to you, like LinkedIn, social media, email, phone, what are the best ways to reach out?
Always happy to talk to anyone. LinkedIn is my primary source of sharing. It's how I first saw Dan months and months ago. And then when you started playing chess, I said, I have to know him. So LinkedIn is easy, but people are welcome to call me, 480-387-6900. 7879.
All right, I love it. I love it. And that brings me to the last part. Let me see if zooming in makes this more intense. Yes, it does. All right, this is my public service announcement. It's not for Robby. It is. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident that it's due to the downright hideous subscribe button down there that you can get rid of for free. And like, honestly, it's embarrassing. If you have any Zoomers in the house and they see that you haven't hit the subscribe button, they're going to judge you. Maybe you're above that, but full disclosure, I want people to hit the button so that YouTube starts to pay for these videos instead of me. I think that would be amazing. The trade-off to you, just to be clear, is that my videos may show up in your list of suggestions, but you can go ahead and ignore those suggestions because, quite frankly, I just appreciate the fact that you spent this time with me. Just like Robby, I appreciate you joining me today. That's been great.
It's been great, Dan. I thoroughly enjoy the way you produce your stuff.
Awesome. Thanks, man. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B.me or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.